All right, welcome to this explainer. Today, we're totally peeling back the layers of the modern credit system to figure out what your three-digit FICO score actually means. If you've ever wondered how one single, seemingly arbitrary number holds so much power over your entire life and why the system operates the way it does, well, you're definitely in the right place. Let's get right into it.
Okay, let's start with the scale of this thing. A staggering 90% of top U.S. lenders rely exclusively on FICO scores to act as the ultimate gatekeeper for your financial access. I mean, think about that for a second. It's really not an exaggeration to say that this single metric dictates whether you can buy a home, lease a car, or sometimes even land a job. It is literally a universal lock on the door to financial mobility.
But here's the catch, and it's a big one. Only 23% of Americans actually reach that elite 800-plus tier. That means the vast majority of us, 77% of the population, are on the outside looking in. And if you aren't in that top tier, you are absolutely paying a premium for everyday financial products.
And the current macroeconomic environment is just pulling people downward. With the average score dropping to 715 in 2025, which was driven heavily by inflation pushing 24% of consumers to miss payments, millions of everyday people are unwittingly being forced into paying a massive poor tax. People are just trying to afford basic necessities, but those missed payments translate directly into a lower score, which then instantly makes life even more expensive. It's a brutal cycle. Section 1. The poor tax and the cost of subprime.
So, let's compare these two brackets. Falling into the 620 to 639 range locks you into a completely different financial matrix than someone scoring 760 and above. You aren't just paying a few dollars more. You are effectively living in a parallel economy where the exact same house or the exact same car costs you significantly more money over its lifetime.
To really put this into perspective, take a typical $300,000 30-year mortgage in 2025. This is the devastating reality of risk-based pricing. A score of 760 gets you a 6.64% APR. But if you drop down into that 620 to 639 bracket, your rate jumps to 7.90%. That seemingly tiny percentage difference costs you exactly $91,757 extra over 30 years. That's nearly $100,000 of your personal wealth just completely erased.
Which brings us to Section 2. Behind the curtain and the hidden profit mechanics.
We tend to view credit scores as this kind of moral grade for how responsible we are. But the data shows it actually operates much more like a highly tuned business model. FICO makes over 75% of its profits by licensing its algorithms right to the banks. Lenders then use that lower score as a justification to hit borrowers below a 620 with a 2 to 4% higher interest rate. This deliberately inflates the bank's profit margins, meaning the people who can literally least afford it end up becoming their most profitable demographic.
And just to give you a sense of the sheer scale of this money extraction, in 2022, banks pulled in an astonishing $9.9 billion from overdraft fees alone. And that profit didn't just come evenly from everyone. It was heavily targeted at people maxing out their credit just to survive. These are consumers whose lower scores keep them completely locked into high-fee products.
So this leads to what we can only call the gamification of credit. Have you ever finally paid off a huge loan, maybe expecting a gold star, only to watch your credit score actually drop? It's absurd, right? But because payment history holds a massive 35% weight in the algorithm, closing an account can actually hurt you. The system essentially punishes you for being completely debt-free. If you aren't actively borrowing, your score suffers. It gamifies consumers into this state of perpetual profitability for lenders.
Moving on to Section 3.
The Matrix Premium, Systemic Barriers, and Wealth. Looking at some recent 2025 data out of New York City, the wealth disparity is just massive. The median wealth for Black households sits at $2,800, compared to $320,000 for white households. The research highlights how low scores and debt erase over half of minority assets. Because access to credit relies so heavily on these scores, the system often forces higher rates onto marginalized communities, which just perpetuates a vicious cycle. In many ways, credit scoring actually acts as a proxy for historical discrimination, baking those disparities directly into financial reports and making it incredibly tough to close the wealth gap.
And honestly, it's a generational wall, too. Fast forward to data from 2026, and the average Gen Z score sits at just 676. Remember our mortgage breakdown earlier? A 676 score makes buying a home prohibitively expensive. This effectively traps young workers in a permanent cycle of renting. And to make matters worse, the higher rates paid by these subprime and younger borrowers are effectively subsidizing the lower-risk, low-interest loans being handed out to older, wealthier populations.
All right, finally, let's hit Section 4, the reality of the perfect, unprofitable borrower.
Because here's the ultimate twist in all of this. Your FICO score? It doesn't actually predict your ability to build personal wealth at all. Instead, it measures a concept researchers call borrower extractability. It grades exactly how much profit can be safely squeezed out of you through interest and fees before you default. Being genuinely good at building personal wealth is fundamentally different from being a profitable customer for a bank.
And because of that extractability factor, lenders don't actually want everyone to have a perfect 800-plus score. That 23% at the very top, the banks consider them low profit because they pay their balances in full every month and avoid interest. Honestly, lenders want you right in that 47% mid-range sweet spot between 650 and 779. In this optimal yield zone, you're responsible enough not to default, but leveraged enough to generate massive revenue for them. If your score is too perfect, you just don't make them enough money.
There's a quote from the source material that really hits the nail on the head here. It says, FICO doesn't predict wealth-building ability, but borrower extractability. This perfectly explains the bizarre reality of our modern economy. It's exactly why a completely debt-free millionaire, someone who pays purely in cash, might actually face borrowing barriers and score drops. Meanwhile, heavily leveraged, struggling consumers who are just making minimum payments are the literal engine fueling trillions of dollars in bank spreads. The system isn't broken. It's operating exactly as it was designed to.
Which really leaves us with this one final, highly provocative thought to take away from our explainer today. If being a perfectly responsible borrower who holds absolutely no debt makes you utterly unprofitable to the institutions grading you, who is this financial matrix truly built to serve? Thank you so much for watching, and keep questioning the data behind the systems we navigate every single day.